name is Charlotte Wood, and I am a certified loan officer. Today we are going to talk about mortgages. A mortgage is a promissory note with the conditional pledge of collateral, like real estate, to a lender for the repayment of the promissory note. The down payment is the amount of cash that is applied toward the purchase of the real estate prior to the placement of the mortgage. The mortgage payment is the monthly amount that is due as a condition of the repayment of the mortgage note. The total mortgage payment is a combination of both the interest and the principal. The interest is based upon what the annual interest rate that was agreed upon at the signing of the mortgage spread out over the term of the loan. The principal is the amount that is applied toward the repayment of the amount originally borrowed. Mortgages can come in many types, meaning a variety of interest rates and terms of repayment. The most common type is the fixed rate mortgage. This is where the interest rate that is agreed upon at the signing of the mortgage is kept constant throughout the term of the mortgage. Another common type is the adjustable rate mortgage. The interest on this type of mortgage can fluctuate either up and down. It is usually based upon some kind of indicator like the prime rate. The amount of principal that is repaid each month stays constant, while the amount of the interest that is paid fluctuates with the rate. Adjustable interest rates are usually sold initially at lower rate than a fixed interest rate mortgage because there is an expectation that the rate will increase over the life of the loan. Qualifying for a mortgage is sometimes a difficult process. There are many factors that go into the formula for qualifying. Those qualifications are also dependent upon what type of loan you are trying to obtain. The first thing to do when purchasing a home is to look at how much of a house you want, how much of a monthly payment you can afford, and how much money you have for a down payment will indicate what kind of mortgage you can afford. To calculate what kind of a mortgage payment you can afford, lenders will look at your debt-to-income ratio, sometimes referred to as DTI. Take your gross income and multiply it by 41%. Then start subtracting out set monthly bills that would show on your CBI, which is your credit bureau. For example, credit card payments and car payments. You also need to subtract child support, alimony, or any loan you may have. The amount left over is what you can qualify for as your monthly mortgage payment, including taxes and insurances. Lenders will look at your debt-to-income ratio to determine your pre-approval. Choosing a lender can seem like an overwhelming task, but should be shopped just like any major purchase. You never buy the first car you see, and you always try to play one car dealer against another. You should do the same thing when looking for a mortgage loan. Some of the questions you should ask are, can the lender help you with the type of mortgage you are trying to get? Not all lenders do mortgage loans. What interest rates do they have available? Keep in mind that the lowest rate they offer may not be for the loan that you want. What closing costs can you expect to incur? This is where most will differ and good shopping will pay off. Keep in mind also that there will be money that you will have to have on hand when you close on the house. Along with the down payment and the closing costs, there are property taxes and homeowners insurances. You should expect to pay 2 to 3% of the amount of the loan for closing costs and prepays. Sometimes it can be more in other areas where taxes and insurances are higher. Many lenders will try to get you to lock in your rate with them as a way to get you to sign with them. To lock in your rate means that you are setting your interest rate at an agreed upon amount. The only reason to do this is if you are worried about interest rates rising before you close on your loan. Purchasing a home is exciting and can be a lot of fun. When applying for a loan, in order to make that experience enjoyable also, make sure that all the documentation that your loan officer has requested, such as recent copies of pay stubs, W-2s, bank statements, etc., is given to them in a timely fashion. Please remember that problems can arise. If an underwriter sees something that raises questions, such as NSFs, large deposits, periods of unemployment, It could cause the underwriter to ask for more documentation. For other mortgage definitions, please feel free to visit www.emcccorp.org and click on to Educational Materials and refer to the glossary of terms. Thank you and happy house hunting.